Welcome to This Explainer. Okay, let's just dive straight into a pretty harsh reality that analytical prop traders face every single day. Picture this. You're executing your strategy absolutely flawlessly. You hit your profit target. You maintain a staggering 90% win rate. Everything looks totally perfect on your end. But here's the kicker. Despite all of that trading perfection, you still fail your evaluation. Sounds incredibly frustrating, right? But the truth is, it happens constantly. So today, we're breaking down the hidden architecture of modern prop firm evaluations. We're going to look specifically at the compliance traps and the unwritten rules that manage to sabotage even the most profitable traders out there.
So, can you actually fail an evaluation while being up, say, 10% by day 3? As crazy as it sounds, the answer is resounding yes. And understanding exactly why that happens requires a massive paradigm shift. You see, prop firms aren't just testing your trading strategy to see if you can make a quick buck. They are testing your discipline under a highly specific, rigid structure. If you're up 10% but you violated a time rule or a consistency threshold to get there, the firm honestly doesn't care about your profits. They care that you proved you can't color inside their lines.
To really put this into perspective, let's look at the data from an internal audit of a top 3 prop firm. The numbers are honestly staggering. An incredible 87% of evaluation failures are not because of negative P&L or blown accounts from bad trades. 87% of failures happen simply because traders break the rules. Only 13% fail because they actually lost too much money in the markets. That one single data point completely changes how we need to approach these evaluations. Here is our roadmap for today's explainer. First, the paradigm shift. Second, architecture of prop rules. Third, the structural traps. Fourth, the human element. And finally, the automated advantage. Let's get right into it.
The hidden architecture.
Every funded program out there comes with a contractual rule sheet, and these are the common limits you're actually playing against. You've got your max daily drawdowns, usually somewhere between $500 and $3,000. You have total loss limits hovering right around 6 to 12%. And then you have time rules demanding you trade for a minimum of 5 to 10 days, consistency rules preventing massive one-day profit spikes, and of course, strict news restrictions. It is a whole lot of hurdles to jump over. But the absolutely crucial point here is this. These rules are a compliance game. They are specifically designed to weed out traders who lack structural discipline, regardless of how good their actual market entries are.
Section 2, the structural traps. This brings us to our first major failure trigger. And honestly, this is a massive light bulb moment for so many traders. The trailing drawdown. Let's define this very carefully. A trailing drawdown is a maximum allowed loss limit that trails your account's peak equity, not your starting balance. The trap here is that a lot of traders mistakenly assume the drawdown only trails when they take a loss on their initial starting balance. But the reality? Most firms trail on your highest floating equity. Let's put some real math to this trap. Imagine you start with a $50,000 account and a $3,000 maximum trailing drawdown. You have a great day, right? You grow your equity to $52,000. Because it trails your peak, your maximum loss limit now moves up to $49,000. Now say you close out your trades and your balance settles at $50,500. Hey, you're still in profit. But if you take a subsequent loss of just $1,501, you hit that $49,000 threshold and boom, you failed the evaluation. Manual traders miss this invisible math by literally $5 all the time. It's wild. And this is exactly where automation steps in. Platforms like TradeRx have internal logic that auto-freezes your account to prevent you from crossing this exact line.
Okay, moving on to our next trap, time rules, or why going too fast does not equal a win. Let's say on day 1 you catch an absolute killer setup. That's great. But wait, many firms have a clause stating no more than 30% of your total profit can be made in one single day. They actively punish one-day wonders. So, to just survive days 2 through 4, you have to execute consistent smaller scalps just to comply with the rules until you finally hit your day 5 minimum active days requirement. If you try to just coast after a big win, you'll break your consistency rule. This is exactly why analytical traders use tools like Dr. Markets. It automatically splits entries and scales risk to essentially stretch out that compliance timeline without ever overexposing the account.
Then we have failure trigger 3, restricted news events. We are talking about the heavy hitters here: CPI, PPI, FOMC statements, and non-farm payrolls.
Firms routinely ban trading 2 minutes before or 2 minutes after these major economic releases. And this brilliantly illustrates the strictness of the whole evaluation. Because even if you are in a trade that makes you money during this window, it will be flagged and you will be disqualified. Saying, "Oh, I didn't know CPI was today," is an excuse that holds absolutely zero weight. It is an excuse-free zone. The best solution? Automated calendar blocks that check the schedule daily and lock you out of those restricted windows entirely.
Section 3. The human element.
Now we get into the errors caused by the traders themselves, starting with failure trigger 4, rule inconsistency across platforms. On one side, you have your third-party platforms. Maybe you're running trade copiers or juggling multiple dashboards. These constantly suffer from sync issues, different P&L calculation math, and slippage. But on the other side, you have the prop firm's back end, and they enforce strict balance tracking with absolute zero tolerance. When these two systems conflict, you end up with doubled trades, ghost entries, and ultimately a drawdown breach. Using unified logic that connects directly to a single account is really the only way to ensure your orders aren't being doubled up by syncing errors. And that leads us to the most brutal trigger of them all, failure trigger 5, emotional violations. Most rule breaks honestly don't happen because a trader didn't understand the math. They happen because of a rapid emotional descent. Step 1, you take an unexpected loss. Step 2, fear, anger, or maybe overconfidence kicks in, and you double your position size to win it back. Step 3, you start revenge trading, pushing into an illiquid session or chasing just one more scalp right before the cutoff. And Step 4, a complete catastrophic rule breach. It is an emotional spiral that happens to the absolute best of us when we're trading manually.
Section 4. The automated edge. So how do you actually solve the human element? You hard code your emotional limits. We're talking about setting strict parameters, like a maximum of 3 trades per hour, a max 1% P&L loss per session, and auto-freeze after 2 consecutive losers. Platforms like TradeRix allow you to mathematically enforce these exact limits. Once you hit a threshold, the system automatically locks you out. There is literally zero room for negotiation with yourself. You cannot rage-click your way into a new trade because the software just will not let you.
Plus, automation protects you from the bonus hidden rules that even already funded traders completely miss. You have to pay close attention to this unread fine print. We're talking about withdrawal restrictions where you have to hit a certain threshold to even get your 80-20 split, payout delays of 14 to 30 days, scaling caps that limit how fast you can increase your lot sizes as your account grows, and inactivity policies that'll literally close your account if you sit idle for just 15 days. Some firms even aggressively review your first post-funding trades before they release capital. Tools like Dr. Markets tag these specific rules per firm, applying them directly to your master plan so you never accidentally risk a post-funding violation.
Let's put this all into perspective by comparing 2 traders in a quick case study. Trader A traded manually. Now, they generated an impressive 7.1% profit, but they accidentally traded on a CPI day and they dragged their maximum drawdown down to negative $2,950, which is dangerously close to their $3,000 limit. The result? They failed. Now look at Trader B. Trader B used automated compliance. They only made a 6.3% profit, but their system automatically blocked news events, and their maximum drawdown was safely capped at negative $1,800. The result? Passed and funded. Despite a lower overall profit, the automated trader won because they successfully survived the compliance game.
Ultimately, it really all comes down to this core idea. The best traders don't beat the system, they build within it. Prop firm evaluations are not a pure profitability challenge where the highest return wins. They are a highly structured compliance test. If you are constantly trying to outsmart the rules rather than adopting a system that flawlessly operates inside of them, you're pretty much setting yourself up to be part of that 87% failure statistic.
So, look at your current setup and ask yourself, are you basically playing roulette with hidden rules just hoping your manual tracking doesn't miss a $5 trailing drawdown limit or a 2-minute news window? Or are you ready to finally automate your compliance and secure your edge? Stop letting structural traps kill your profitable strategies. Plan meticulously, automate your discipline, and treat your evaluation like the compliance exam it truly is. Thanks for joining me on this explainer and keep building within the system.